Welcome to the CFA Level I presentation on alternative investments. Our approximate agenda will be as follows. We will first talk about mutual funds and exchange traded funds. So this will represent part 1 of our presentation. In part 2 we'll talk about real estate. In part 3 we'll talk about venture capital and hedge funds, and finally in part 4 we will talk about closely held companies, distressed securities and commodities. Now, as you can see, this whole class of investments called alternative investments is pretty diverse in of itself, and over these next few lectures we will talk about each class individually. But if we are to make some generalizations about alternative investments, they would be as follows. So in general, an issue with these alternative investments is that of liquidity. So most of these investments are not very liquid, and obviously an investor needs to be concerned about that, or at least aware of that. Second general point is that the market values of these are often difficult to determine. So if you are buying a stock, for example, you can easily determine the market value based on the price in the stock market. But when you are going and buying some real estate, as an example, then obviously determining market value is difficult. Similarly, if you want a piece of a closely held company, then how do you determine market value? So clearly that in general is an issue with alternative investments. Next, there is a big issue with getting historical data, and just as a contrast, there is tremendous amount of historical data available for publicly traded stocks. But for example, how much data is there on again real estate? So data availability of historical data is an issue, and obviously given all these factors, the amount of analysis required is pretty intense. So these are some general characteristics. Obviously at times they are exceptions. So for example, we might have some mutual funds that are very actively traded, or some exchange traded funds that are actively traded. So these points have exceptions, but as I said, in general they apply, and specifically they apply to most of these alternative investment categories. So let's talk first about mutual funds. Managed investment companies or mutual funds collectively manage funds for a group of investors. Now, just to understand this through a very simple example, let's say that we have about 1,000 small investors. So each one of these have, let's say, about $10,000 to invest. So $10,000 times 1,000 investors. Now $10,000 isn't necessarily enough to create a diversified portfolio. So what could potentially happen here is that these investors essentially pool their money together, and the $10 million that is created by pooling this money together is all put into a mutual fund. So this mutual fund will have a mutual fund manager, and with the $10 million that is now pooled together, he can create a diversified portfolio. And then against this diversified portfolio, he can issue mutual fund shares. Now let's say that initially we create 1 million shares. So 1 million shares are created, and each share initially then would be worth $10. And obviously an investor who has invested $1,000 initially would get 100 shares of this mutual fund. And as the value of the underlying shares, or the shares that are part of this mutual fund, as the value of this diversified portfolio goes up, the value of each mutual fund share will go up. So that is a general point. You can clearly see that there is diversification going on, and there is obviously cost savings going on, because for all these 1,000 investors, you just need a small team of people doing research and creating the diversified portfolio, and that benefit then goes to all the investors in this mutual fund. So that is a simplistic explanation of how a mutual fund works. Now, some important terminology in the context of a mutual fund. Perhaps the most important term is net asset value, or NAV. Anytime you look at a mutual fund prospectus, you will definitely see a number for the net asset value. And how is this calculated? It is simply equal to the total assets for that fund minus any liabilities divided by the number of shares. Now, if we take this very simplistic example, then initially, let's say the total assets over here are 10 million. Let's say that initially we don't have any liabilities, and then the number of shares issued by this fund is equal to 1 million. So initially our NAV here will be 10 over 1, which is, so our net asset value is 10. So that's our net asset value, and NAV is a per share number. Obviously, as the value of the assets in the portfolio goes up, then the NAV will also go up, and NAV is used as a basis for the valuation of these shares. We can have two kinds of mutual funds, open-end funds and closed-end funds, and you need to understand the distinction. Most funds are actually open-end funds, and these open-end funds essentially stand ready to redeem investor shares on request. So the point being this: if given the example that I just showed you, if an investor wants to return the mutual fund share back to the mutual fund will accept it, sell the investor's share of the underlying stocks, for example, and give the money back to the investor. Another point related to open-end funds is that, let's say initially we had $10 million worth of shares. Now, if there is substantial interest and more shareholders want to join, or more people want to join this open-end fund, then more people can come in and say pay $5 million, and those $5 million can be used to buy additional shares and hence create additional shares of the open-end fund. And since these open-end funds stand ready to redeem investor shares on request, the share value for these open-end funds is generally equal to the net asset value. If not, then that would result in arbitrage opportunities. But as far as you're concerned, you can just generally assume that for open-end funds, the share value is very close to NAV. We also need to worry about the concept of fund management fees. So the fund manager that I showed you on the earlier slide, or the whole fund, obviously there will be some costs involved, and we are going to do an example on this. But very briefly, if the mutual fund charges you, the investor, some money for entering into this mutual fund, that initial fee is called a front-end fee. If there is a fee associated with redeeming your shares, in other words, if you go to the mutual fund and say, okay, I want to return my mutual fund shares and give me my money, if there is a fee associated with that, then that's called a back-end load. And then a fee that's charged every year is called the annual fee, and this usually is made up of our this is sometimes also called our operating expenses, and this is generally made up of distribution fees, any sort of management fees, and other fees. So collectively these are sometimes referred to as operating expenses. In the context of mutual funds, you should know this term, expense ratio. Expense ratio is generally calculated as operating expenses divided by average assets. Now obviously, all else equal, you generally want to invest in mutual funds that have a relatively low expense ratio. You have seen this also earlier in other topics where very simplistically put, the expense ratios of funds that simply track an index are going to be lower than actively managed funds which are trying to constantly look for undervalued securities. So if you recall, passive funds which are simply trying to track an index will have relatively low expense ratios, and actively managed funds will tend to have high expense ratios. Closed-end funds. Now the point with closed-end funds is that shares are issued only once. So in my earlier example, if initially $10 million were collected and say 1 million shares were issued, then there will be no further issue of shares. These 1 million shares are then traded in the secondary market. So in a sense, they then become like the shares of any other company or any other entity. So they can be, you can buy them on margin, you can short them, and so on. But essentially they are like regular shares, and since they are like regular shares, the value is determined in the secondary market. And even though we need to be concerned about the net asset value, but it needs to be kept in mind that closed-end shares can often trade at either a premium or a discount to NAV. So for example, if the market has a very high opinion of the fund manager and have expectations that the fund manager will do a good job in the future, then there will be high demand for these fixed number of shares, and most likely the shares will trade at a premium. However, it is also possible if, for example, you do not have the investors don't have a high opinion of the fund manager, then the shares would trade at a discount to NAV. This means that if the NAV is 10, then the market price might be 8. And actually in Pakistan and many other countries, very often we find that closed-end funds trade at a discount relative to NAV. We do not need to get into the reasons for that. Okay, from an exam perspective, this is an important topic where I'm actually going to model this on example 1 in the curriculum. So we have a situation where a mutual fund issues 3 different classes of shares: Class A, Class B, Class C, and this is quite common. We will also assume that each one of these classes, the investor expects that the return will be 8%, and this is just a given. So based on how the economy and the underlying shares and the risk profile of the shares, so given all these factors, the investor is expecting that each one of these class of shares will grow at 8%. But the difference between these 3 classes is the expenses involved. With Class A shares, we have a front-end load of 3%, which means that if you invest $1, then 3% is taken away right up front. That's why this is called a front-end load. As far as the back-end load is concerned, there is no back-end load, and the annual expenses for Class A is 1.25%, and if you recall from before, annual expenses would typically include distribution fees, management fees, as well as other fees. Class B shares have no front-end load, so there is no front-end load. There is what's called a deferred back-end load, which means that there is a 5% fee in the first year. So essentially, if you put money in and then immediately redeem your shares or take out your money, then there is a 5% fee, but then it goes down by 1% per year. So if you keep your money in for 1 full year and withdraw after that, then there will be a 4% charge. If you keep your money for 2 years, then there will be a 3% charge when you redeem, and so on. So obviously investors are being encouraged to leave their money in the fund for as long as possible, and in this case the annual fee is 1.5%. For class C shares, again there is no front end load, but there is a back end load of 1% for the first 2 years. That means that if you withdraw after 3 years, then there is no fee, and the annual expenses here are 1.5%. Now the question is this: you are asked to calculate what is the return on your money for 3 different possibilities. Let's say that one scenario is that you invest for a 1-year horizon, and the way we can work on this is, let's assume $1 is invested. So if $1 is invested in class A shares, then how much money will you have after a year? And this is straightforward. If $1 is invested in class A shares, 3% goes away right off the bat. So you have $1 into 0.97, or you can do it as multiplied by 1 minus 0.03. So that gives you 97 cents right up front, and then assuming that this grows at 1.08, so that means this is growing by 8%, but we also have our annual expense of 1.25%, so we will multiply this by 1 minus 0.0125. So you can do the maths, and you can also check this in the curriculum, but this is how much money you will have after 1 year if you invest in class A shares. What if you invested in class B shares, and if you withdraw after 1 year, remember there is a redemption fee of 5%. So what happens? The $1, initially there is no front end fee, but we are expecting this $1 to grow at 8%, so we multiply this by 1.08, and then we are hit by 2 fees at the end of the year. One is our regular annual fee, so we multiply by 1 minus 0.015, so that's a 1.5% fee, plus there is a 5% redemption fee for 1 year. So there we then multiply by 1 minus 0.05. So this will give us how much money we have after 1 year for class B shares. And then for class C shares, we again have $1, and then this grows, so $1 that grows at 8%. There is an annual fee of 1.5%, so 1 minus 0.015, and then we have a 1% fee for withdrawing within 2 years, so multiplied by 1 minus 0.01. So this is for your 1 year period. Now what if the investment is for a 6 year period? Then for class A shares, we have $1. Notice that the 3% fee still applies, so for we will still have that initial charge of 3%, so into 1 minus 0.03, and now this will grow at 8% for a 6 year period. So you multiply this by 1.08 to the power of 6, and you are going to have a 1.25% charge every year. So you also multiply this by 1 minus 0.0125 to the power of 6, and you can do the maths. So that's how much money you will have after 6 years if you invest in class A. If you invest in class B shares, now the good thing is there is no fee involved here, because you have gone to 6 years. So the $1 now grows at 8%, and this is for 6 years, and the only charge you have is the 1.5%. so you multiply this by 1 minus 0.015, to the power of 6. So that will give you your answer. And then for class C shares, you have $1, which is invested, which grows at 1.08 to the power of 6 multiplied by 1 minus 0.015 also to the power of 6. So this is how you calculate the amount of money you will have after a given number of years, and given your investment horizon, you can figure out which class of shares will be best for you. And I think this should be good enough, but if you want, you can follow up and see this example again in the curriculum. It's on page 190. Now let's talk about investment strategies. If you look at the mutual fund prospectus of any major mutual fund company, you will actually see several funds, and funds can be categorized along several dimensions. You can have funds with different styles. So for example, you can have a mutual fund that's based on growth stocks. So in the mutual fund prospectus, it would be clearly stated that this fund only invests in growth stocks, and then obviously there will be a definition of growth stocks, and an investor will clearly know that if he puts his money into a mutual fund which has a growth strategy, then the risk is relatively high and the expected return can also be relatively high. Another style is to only invest in value stocks. So these would generally be stocks with low book value, with low market values relative to book values, with relatively low PE ratios. So here generally, compared to a growth strategy, the risk is relatively lower and the expected return would also be relatively low. So this is an example of different styles of a mutual fund. You can also have mutual funds based on different sectors. So for example, you can have a mutual fund that is based on the healthcare sector. You might have a mutual fund that invests in companies that are in the technology sector, and so on. So those are sector funds. An index fund would be a fund that tracks a specific index. So this would clearly be a passive fund. So a fund that tracks the S&P 500 would classify as a index fund. Global funds are becoming more popular. So global funds are funds which have securities from around the world, and this would typically also include the home country. So if you have a global fund based in Germany, that would have German shares, but it would also have shares from other companies from around the world. So that's a global fund. A stable value fund generally refers to funds that invest in short-term fixed income securities or guaranteed investment contracts. So this essentially, in Pakistan, given the volatility of the stock market, these sorts of funds have become very popular because and they are sometimes also referred to as capital preservation funds, because you get a certain return that you can be fairly confident about and the risk is relatively low. So a lot of companies and treasury departments at companies would also invest their excess liquidity in stable value funds. Now let's talk about exchange traded funds. There is a lot of material in the curriculum as well as in a lot of study notes on exchange traded funds or ETFs, and that is because ETFs have become extremely popular over the last couple of decades. What I have tried to do here is summarize on one slide the material that I think is most important from an exam point of view. Obviously I'll be skipping some details, but if you really want the details, you can read the curriculum. I am pretty confident that the material on this page will cover you in terms of possible exam questions. The first thing that you need to memorize when we talk about exchange traded funds is what are they? And the answer is, exchange traded funds are essentially index based investment products that allow investors to buy or sell exposure to an index through a single financial transaction. So in a sense, they are like index funds, but there are some differences which we will now highlight. One of the terms that you essentially need to memorize is that there is a special way of creation and redemption involved when we talk about exchange traded funds, and that is the in-kind creation and redemption process. If you are itching to know exactly what this means, then you should read page 194 and 195 of the curriculum. But for the most part, you just for the exam, essentially, as long as you know this term, you are in good shape, and you need to know what's the advantage. So this in-kind creation and redemption process, because of this, exchange traded funds have two major advantages over mutual funds. One is that there is less capital gains taxes. So so you just need to realize that this is one of the advantages. So across the fund, there are less capital gains taxes relative to say a open-ended mutual fund. So that's one advantage. Another advantage that comes from this in-kind process is that the exchange traded funds typically trade close to NAV. So this is an advantage over the closed-end funds. Open-end funds generally would also trade close to NAV. Some other advantages, so diversification. Clearly, if you invest in an exchange traded fund which is based on an underlying index, you get a diversification benefit, and that you do by investing actually in any passive index based fund, but obviously this is an advantage for exchange traded funds. Exchange traded funds, the shares, you are allowed to do intraday trading. You can short the shares, you can do margin transactions. Now a quick point here is that with open-end funds, you cannot do intraday trading. These are open-end funds are redeemed at the end of the day based on market prices of the underlying shares at the end of the day. So in that sense, exchange traded funds are better than open-ended funds, but closed-end funds you are allowed to do intraday trading. So as you notice, exchange traded funds have some of the benefits of both open-end funds and closed-end funds. Another point is that ETFs can be shorted, and they can be you can buy them on margin and so on. So essentially the shares can be treated like any regular shares on the market. Is this an advantage or not? It really depends. If you are the sort of investor who is holding these shares for the long term, then obviously intraday trading does not really matter. If you don't generally do short transactions or you don't buy on margin, then this isn't really an advantage. A couple of other points. Generally speaking, futures and options are available on exchange traded funds. So if you are a sophisticated investor who wants to use futures and options to mitigate risk, then these are generally available for ETFs, and these are not available for open-end funds. As you might imagine, ETFs have a relatively low expense ratio. Since they are tracking an index, these are effectively passive funds, and hence the expense ratio is relatively low. What are some disadvantages of exchange traded funds? In some countries, the exchange traded funds simply track a narrow based index. What this means is that in a given country you might have an index of just say 10 shares. So this is a narrow based index, and obviously then the ETF is only tracking those 10 shares and not the overall market. Now obviously if the ETF is based on a broad based index, then this disadvantage does not apply. Another possible disadvantage is that the liquidity sometimes of an exchange traded fund is low. If the liquidity of an ETF in a given country is low, that means the bid-ask spread is going to be high. And finally, ETFs are not always feasible for large institutional investors. So for large investors, they might create their own fund which tracks a given index. So obviously the large institution can decide for itself whether ETFs are feasible or not, but studies have shown that in general they are not so feasible for large institutional investors. Some risks. One is the obvious market risk. So if ETF is based on an index such as say the S&P, then obviously the fluctuations of the S&P index are going to be reflected in the valuation of the exchange traded fund. Trading risk essentially refers to if the liquidity is relatively low and hence the bid-ask spreads are high, then we have a trading risk. Tracking error risk means that at times the return on the index or the return on the exchange traded fund might not properly track the underlying index. The reasons we will discuss in level 3. At this point, just know that tracking error means that the return on the ETF might not properly track the underlying index. If there are any derivatives involved in the exchange traded fund, then there are risks associated with the derivatives, and not surprisingly that risk is called derivatives risk. And finally, there is currency risk and country risk. So if you are a US investor and you invest in let's say an Indonesian exchange traded fund, then obviously there is the risk of the foreign currency devaluing. There is a risk associated with the foreign country in general. So those two risks are collectively referred to as currency risk and country risk.